Pretty simple. When the Fed's raising interest rates, odds are you're going to not make money. You're going to lose money. You're going to make less than your coupon. When the Fed's cutting interest rates, you're going to make more money because your bond price is going to go up.
Hello, everyone. This is Shana Sissel, founder and CEO of Rareview Capital Management, and you are tuning in to a new episode of What's the Alternative? This episode features Michael Sedacca. He is a partner and portfolio manager with Rareview Capital, one of our liquid alt manager partners on the Rareview platform. Rareview is a firm you might not have heard of, but has really interesting product, and we're going to dive deep into some of the really unique ETFs that Rareview has brought to market. So with that, welcome, Michael. Thank you for joining us.
Thank you, Shana. Thank you for having me.
Why don't you tell us a little bit about your background and how you kind of ended up at Rareview Capital?
Sure. Always had a affinity to the fixed income markets and managing money. And about 10 years ago this month, I started working with my partner, Neil Azus, and we wanted to build products that were differentiated, that would not be more passive off-the-shelf products that you might get from a mega ETF provider or fund provider. And that is what started our journey to create one of the alternative products that we'll speak about today, which is the dynamic fixed income strategy. It is a high income. So if you think 10 years ago, interest rates were at zero, income was very hard to come by, especially for savers or retirees. We wanted to create a product that was differentiated, that could give them that confident, repeated income on a month-to-month basis to fund their retirement or their lifestyles.
Interesting. And, it's funny because when I started working in the liquid alt space and I started evaluating ETFs, really mutual funds too, but mostly ETFs, as the industry's moved more and more to that structure, there isn't a ton of non-traditional kind of alternative products in the fixed income space that have a yield component that is really reliable and stable. And I think one of the interesting things about your product is it actually is fairly reliable and stable in that respect, which stands out to me. So, fixed income markets, we don't talk about a lot on this show. So it's really good to have you here because our audience doesn't get to hear a ton from fixed income side. But I'd love to hear a little bit more about, some of the complexities in fixed income. We keep seeing on the news discussions about the yield curve and interest rates and how despite Fed policy and Fed rate cuts, you're not seeing that necessarily reflected in fixed income markets and in the yield curve. Can you talk a little bit about some of the fixed income dynamics that are going on today?
Sure, certainly. So going back 5 years ago almost, there was a pandemic. There was a significant amount of stimulus, whether it was from the monetary angle from the Federal Reserve or the fiscal angle primarily, which had not happened for well over a decade at that point. Significant amount of money was created. And lo and behold, there was a significant amount of inflation. And the Federal Reserve embarked on the most aggressive and most significant interest rate hiking cycle to date. That caused a large amount of damage in the fixed income markets. At the time, interest rates were zero or close to zero across the entire yield curve, which made the price sensitivity on a generic fixed income portfolio never been higher, meaning 100 basis point increase in yields would have a outsized negative impact on your portfolio. And as a result, there was a even larger movement towards alternative products or cash or T-bills because you couldn't receive that income without taking outrageous price risk to achieve it in fixed income. Now, fast forward, the Federal Reserve has raised interest rates by 5.5% at that point. Inflation, now having gone up, came back down at the fastest rate of all time. And the Federal Reserve became prepared to cut interest rates. That started about 6 months ago, and they cut interest rates by 100 basis points. So even though they raised them by 5.25, they've only cut it by 100 basis points in the context of Normally there's 3 to 4% of interest rate hikes, and then sometimes more in terms of interest rate cuts because it would come from a higher level. And that's what we're going to determine over the next 1 to 2 years is where's the neutral policy rate? Has it shifted higher with fiscal stimulus being at a much higher level than what it has been in the past? And is there going to be any impact from the incoming administration, whether it's in Congress, which the Republican Party holds both houses, and the executive branch? That will be what it takes moving forward to determine fixed income. But more importantly, how that impacts inflation. Inflation has the highest beta to the Federal Reserve policy moving forward. So that's the one thing we're laser focused on is what is the outlook for inflation? Real estate prices have come down, rental prices have come down. That's the overall picture for the Federal Reserve. And if it makes sense, Shana, I could go into more in terms of fixed income asset classes, if that will be helpful.
Absolutely. That like I said, our audience never gets to hear a lot about fixed income. We don't have a lot of fixed income guys come on, but it's so timely because there's a lot of discussion about rates, and that directly impacts yield curve and bond prices and bond yields. And, we talk about inverted yield curves. And I think a lot of people don't understand that in order to not be inverted, even in cut environments, you still got to have the long end go up. And so there's some technical dynamics there that I think our audience would really appreciate hearing more of. And like I said, we never have folks with your type of expertise on the show. So go for it. This is exactly what our audience wants to hear.
Well, great. Thank you. So first, I'll just start with fixed income sectors with the strategy you referenced before. It's a dynamic fixed income strategy. So it's a multi-sector bond. What that means is anything besides treasuries is what we can be invested into to achieve a high yield or a high total return. And it's not just the traditional investment grade corporate bonds or high yield corporate bonds. There's a significant asset class out there in emerging markets, whether it's hard currency or local currency, investment grade or high yield. Securitized debt, the non-agency space, is much higher in terms of spread or yield that you can achieve versus just buying general investment grade corporate bonds. The spread pickup is well over 100 basis points, if not more. And then thinking more about there's a return to office right now. I'm assuming that all of your listeners have seen that no one's ever going to go to an office ever again. Office buildings are worth zero. They're going to crumble to the ground and you're going to get zero on your investments. The great thing about fixed income is it's highly quantitative in nature. If you can price something or you can see that something is priced at zero, and if the office building crumbles to the ground and there's nothing left of the value of that, and something is priced at zero and you buy it, you lose nothing. That's the best part of it. And if somebody ever goes back to an office ever again and those office values actually go up, you can make a significant return from there, and you're being paid for a investment grade rated piece of paper. You're being paid 3, 4, 5% more than treasuries on that. That kind of risk and the asymmetry is what we look for in our fixed income strategies, because it's not just buy and hold. I'm going to buy a 5-year bond or a 7-year bond and put it away and forget about it for the next 10 years. There is times to be tactical, and that's what we focus on in the liquid alternative space, and being able to be nimble to make those changes, not being benchmark constrained to the aggregate bond index. That's what we shoot for. And you mentioned, sorry.
I was going to say that makes a lot of sense. And bond guys hate me for saying this, so I apologize. But when I was in grad school working towards my MBA, one of the things I used to say is I had to take an equity valuation class. I had to take a fixed income valuation class. I always liked the fixed income valuation class better. And all the bond guys would be like, why is that? It's more technical. There's all sorts of components to it. But the one thing the bond markets have that the equity markets don't have is like a terminal value. Because at the end of the day, the bond has an end date in most cases, and you know what par is. And the bond, everything that happens between when it's issued and it's, the date it matures is kind of gets you back to that spot. So like the mathematics is less opaque, to me at least, because
Sure.
and I think that's the interesting part of a lot of these strategies is there's a lot of technical factors, but at the end of the day, when you think about time value of cash flows and all that like foundational stuff that we talk about when we talk about evaluating any investment, in an equity, you're taking a stab at what the value of that equity is because there's no clear maturity date and there's no clear terminal value. But in fixed income, you have that. So the arbitrage opportunities are much more clear, at least in my opinion. And what are your thoughts on that?
Well, it's funny you mentioned the equity side is that a long time ago, one of my mentors told me something that I will never forget. He said, when you're trading in a stock, you're buying a stock, you're not buying a company. And when you can believe that, when you can understand that about why an equity can be valued as something, and hey, there's the fundamental of this or that, doesn't really matter. You're buying a stock, you're buying a symbol. You don't necessarily care as much about what the underlying fundamentals are. And certainly with fixed income, because it's a less volatile asset, particularly with interest rates at a little bit higher level, it's a less volatile asset. So you have to be cognizant of what's the direction of the Federal Reserve cycle. Where are we in the different regimes of that Federal Reserve cycle? Are they raising an interest rate? Are they cutting an interest rate? Are they preparing to raise an interest rate? Because capturing that part of the Federal Reserve cycle is that makes a big difference on fixed income returns relative to an index or just on an absolute basis. Pretty simple. When the Fed's raising interest rates, odds are you're going to not make money, you're going to lose money, you're going to make less than your coupon. When the Fed's cutting interest rates, you're going to make more money because your bond price is going to go up. Just by, I hate to say it sounds that simple, but it really is the introductory part of a fixed income cycle is capturing that. And is the yield curve going to be flattening or steepening? And just in terms of the yield curve steepening, that really reflects the Federal Reserve is cutting. They're going to create future inflation risk. Okay, it's a steeper yield curve. The Federal Reserve is hiking. They're taking out inflation risk from the market. The yield curve flattens or inverts. When it stays inverted for a long time, as that would be a negative pressure on financing. And financing is a big part or the biggest part. If a company cannot roll over its debt, it will go bankrupt. We live in a world where debt is never repaid, it's just rolled over. So if companies can't roll over their debt, they will go bankrupt, or they will have stress and they'll perform poorly, whether it's their equity or their fixed income.
Yeah, it's interesting. Anyone who's ever taken a Series 7, Series 6, CFA, or any type of fixed income class in graduate school understands the seesaw. That's like the basics of all things fixed income. You have value of the underlying bond par on one side, and you have yield on the other side, and then they kind of move like this. As yields go down, the price of the bond goes up, and vice versa. But there's more to that, like duration and things of that nature. And that's the Fed policy stuff you were just talking about. I'm curious, can you talk a little bit about the environment we're in today? Because the fixed income markets have behaved unusually, at least to an outsider who's not as tuned in to the dynamics of fixed income. And a lot of people are confused as to why the yield curve is not necessarily demonstrating or reflecting what you would expect, given that the Fed has cut rates. And what do you think's driving that? And what do you think people should be aware of as they kind of look at that to make sense of that type of behavior in the yield curve?
Absolutely. And that's one that we've heard a bunch. And really, it stems back to there's a neutral rate of policy for the Federal Reserve, or the Fed funds rate. And that is what level of the Fed funds rate is restrictive or easy, just relative to the economy, or really the financial economy, frankly. We estimate that somewhere in the low to mid 2% range, and it was lower last cycle. So when the Fed raised interest rates from 0 to 5.5%, they overshot neutral by at least 3%. Historically, they're only overshooting it by about 75 basis points. So that's 4 times more than what the Fed would normally overshoot, because they always over tighten. Things are doing well at the time, and they do too much, and something bad happens in the financial system, so they have to revert, or the economy, whichever one matters at the time. So this time being 300 basis points above neutral. The fixed income market priced in that return back to neutral policy, because that's what the Fed always do. They raise too much, they return back to neutral, and we see if they have to cut below neutral because things are going poorly. So heading into the interest rate cutting cycle last September, the market was pre-pricing 275 basis points of interest rate cuts. So the yield curve, if you think about the 3-month Treasury versus the 10-year Treasury, was extremely inverted. It is normally around zero at the start of an interest rate cutting cycle. It was at a negative 170. So there was the starting point was much more than it's ever been. And it's kind of like it was priced for perfection, that there had to be this linear plunge to below 2% inflation, because it was going from top left to bottom right for the past 3 years, or sorry, 2.5 years on inflation. And it slowed down in the fourth quarter of last year. So the market priced in less cuts as a result. And you can add in something for the Republican administration having inflationary effects from more fiscal stimulus. That's really what's taking place right now. Is there was a one-way train of disinflation from mid-2022 until 6 months ago or 4 months ago. And now we're just trying to determine, is inflation going to stay, meaning core PCE, at 3% or the high twos, or is it going to get down to 2%? And there was a few months where that, if it was going to get down to 2%, was called into question. If it's not going to get down to 2%, which is the Fed's target, then they won't cut interest rates back down to 2.5%, if that's what the neutral policy rate ends up being. That's really that's what took place a couple months ago. I assume you're referencing that the 10-year Treasury yield went up significantly after a cutting cycle, which doesn't usually happen. Well, normally we're only pricing in 50 to 75 basis points of cuts. We're pricing in 275 before it starts. A lot has to go right on inflation or unemployment for that to be realized. And that's where we were able to see in real time, going back 6 months ago, the fixed income market was priced for the Fed to cut interest rates by 100 basis points the next day, meaning it's August 3rd. There's a pretty bad unemployment report. Things are going wrong in the stock market. The market is pricing in the risk of, or the Fed actually cutting interest rates 100 basis points tomorrow. That is, something we can identify in real time. That's an asymmetry to bet against, because that is just not appropriate to be priced in advance. And then, fast forward to the end of last year, the market was pricing in that after 100 basis points of cuts, they shouldn't cut ever again. That really means that inflation should accelerate to 4%. That's just the quantitative version of what's being priced into the market. If inflation has to accelerate to 4%, well, if we think there's an equal chance or a better risk is going to go down to 2 than up to 4, that's a time to be aggressive at that stage.
So I think there's 2 questions I have for you that comes out of that. Number one, I want to point out to our audience, one of the things that's really unique about fixed income is this whole argument of passive versus active. It's really hard to be passive in fixed income. And for those of you who look at passive options in the fixed income market, I caution you to understand that it's almost impossible to replicate the aggregate bond index because of the way fixed income works. It's not like you can buy all the exact bonds that are in the aggregate at any given moment, because they may not even be available to you, unlike the S&P 500, where you can actually go out and buy all 500 of the stocks and you wouldn't have an issue. It doesn't work that way in fixed income. So even a passive product is not effectively able to replicate the underlying index in the same way in equity would.
I think at this stage there's 16,000 bonds in the aggregate index.
Yes. And not all of them are at any given moment in the market to be bought and sold.
I would be surprised if 1,000 of them were, honestly, at
exactly.
any given time.
So there's always much higher tracking error, and that's why active is actually a compelling strategy in fixed income because of that dynamic, because even a passive strategy can't truly be replicating a passive index. And with that in mind, can you talk a little bit about where the opportunities lie and what you're seeing? And as it pertains to Fed policy, you've mentioned neutral rates a couple of times. It's funny, I get asked all the time when I'm on TV, about the neutral policy rate. And I always like to remind the hosts that, I don't even think the Fed knows what neutral is. I think we have an idea. But if you look back historically, that 2% number, and even the number we had coming out of the financial crisis, was artificially low. And same with inflation. We keep talking about 2%. Prior to 2008, 2009, like the average historical inflation rate was like 3.5. So like 2 is much lower, and that's kind of pulled out of left field. My understanding comes from some study in New Zealand or some policy practice in New Zealand that everybody just kind of adopted as law. But that's actually a more recent kind of change.
For 2% inflation, you mean? I just want to make sure. I want to clarify.
Yeah, like the target inflation rate of 2%. But I think I'd like to kind of hear your thoughts on sort of how the way monetary policy was approached during the financial crisis has kind of changed the game for folks like yourself to manage fixed income portfolios in a dynamic way. And what are the things you have to think about today that maybe you didn't have to think about in like 2005?
Well, certainly over the past 15 years, you didn't have to really consider fiscal policy as an input. Fiscal policy was in a contractionary direction for a decade coming out of the financial crisis, because there was a significant amount of spending, and it was all about reining that back in to, if the deficit got to 10% of GDP, they want to get it back down to 2 or 1%. So there's a significant amount of balance sheet repair going on. So inflation was low, fiscal spending was low. You get lower interest rates by the Federal Reserve. And I think with the 2% inflation target, I believe that like over the past 100 years or so, inflation's averaged about 1.5% per year, and maybe that's ticked up incrementally over the past, having added the past 5 years in. But that's where they came up with 2%. Really, the past 30 years, of the past 100, or really between 1990 and 2020, was the anomaly. That was the higher inflation anomaly. If you look at over 100 years, that stands out as the anomaly. But before that, it was between 1% and 2% inflation. So I think that's where they came up with it. Of course, it's arbitrary. Everybody changes their mind all the time. The Fed changes their mind every 4 to 6 weeks. That's what's just built into our calculus is, if you think about like a sine wave, they just change their mind all the time. And what they might say today could change 6 weeks from now. Neutral rates, of course, that's just somewhat arbitrary. If you think about it, like, you only know that you ran into a wall if you're driving a car at 100 miles when you've actually smacked into the wall. I think that's kind of how they treat the neutral rate of policy, is they only know that they've done too much or they haven't done enough if they smash into the wall. That's just the only way I look at that kind of thing from them.
That's interesting, because people always talk about, and myself included, how these types of cycles typically end with a policy mistake. And to your point, I never thought of it in that manner. It's the policy mistake happens because you keep making policy decisions until you hit the wall, because you don't really know. It's all kind of arbitrary based on feel and data. It's interesting, though. One of the biggest arguments today about interest rate policy has to do with, when is it appropriate to cut? We've gotten so used to zero interest rate policy. There's an entire generation of investors that knows nothing else. But more importantly, the way that it used to work in terms of policy prior to the financial crisis is a lot of what was being done through the balance sheet didn't exist prior in the way that it exists today. And interest rate decisions were made almost entirely based on what was going on in the economy. So it's a little difficult, I think, for a lot of folks, and especially folks that are just learning, to understand, and even I struggle with this from time to time, why the Fed would cut rates when the economy does not appear to be hindered by the rates as they stand today. And I know there's some forward-looking aspect to it, but my question for you is perhaps this idea that neutral rates have to be at 2% in order for the economy to be in its maximum growth potential, could there be concern that, and in fact, we might overheat as a result of cutting when there's really no economic reason to do so?
I think that was the one thing I learned that was very enlightening for me, is that the Fed controls the financial economy. They have tangential input into the overall economy, because companies might not use debt anymore, or they might be more fixed rate than floating rate. So the digital nature of Fed policy impacting the real economy is much more muted than it ever was, if it has really any, short-term effect, and to me, short-term being less than a 12-month period of time. The biggest thing they have impact over is real estate, and real estate, while it has gone up significantly, I have to imagine on a national basis, prices are up 30 to 40% from 5 years ago. They've been growing at a subpar pace for 3 years now because of the Fed's interest rate hikes. So if they're looking at, from a financial basis, credit growth is negligible, if any. Defaults are up significantly, especially in the consumer channel or the auto channel. The difference is this time than it was ever is everybody was able, corporates or individuals in 2020 and into 2021, was able to term out all their debt at low rates. I'm sure you've heard about the average interest rate on mortgages outstanding right now is mid threes, if we're below 4. And with turnover being at an all-time low in terms of the housing market, they're not getting that higher interest rate and having that impact. So as a result, they're not getting hurt by that. That's the one thing that I would think about, is that the financial economy is somewhat wobbly, but that doesn't really have that much effect on the real economy, because people are still going to spend money, one way or the other, whether the Fed funds rate is 2%, 5%, 10%, or 0. I don't think that makes that big of a difference in the grand scheme of things anymore for most corporations, especially because those same corporations, they have cash. So thinking about Apple as an example, they have $250 billion of cash and $100 billion of debt. They probably love the Fed raising interest rates, because now they're making a bunch more money on their cash, and their debt's at a 2% coupon. So that's a decline in their debt coverage ratio. So they love that kind of stuff, and that's never happened before in history. That's the one main differentiation than in the past.
Yeah, I think it's interesting. I watched an episode of The Compound Effect with Josh Brown. I can't remember off the top of my head who the guest was, but they were talking about how the only person that's being hurt by the Fed policy is your local realtor.
Yes, that's the truth.
And not really the economy as a whole. And I do think that's an interesting point, as the underlying individual consumer in the U.S. has a higher sensitivity to the real estate market, because we all need a place to live. And to your point, most people who have those 3%, sub 4% mortgages, even if they wanted to move, for even like my parents, for example, if they wanted to downsize, like it's not advantageous.
No, not at all. Yeah.
Even if they can't use total cash to pay for a new home, because home prices are higher just in general, even after a sale. But then mortgage rates, they're looking at having a payment that may be more for less than they're paying currently, and that kind of sticks them with the situation we're kind of in now, where there's like no inventory, which prices have come down because people who need to sell realize that buyers just aren't in the market, so you got to incentivize. Buyers aren't there because of the mortgage rate, so prices have to come down so that the payment becomes manageable. There's all kinds of dynamics there, but I think that the consumer itself is much more sensitive to it than probably any other input into like the inflation numbers, and even say gasoline or energy prices. I think that that's something worth noting, as extraordinarily different than any sort of housing market or real estate crisis we faced in the past. In that regards, that's quite interesting. So, as somebody who looks at different parts of the markets, there's a huge component in fixed income of mortgage-backed securities, and securities that are like derivatives of mortgage-backed securities.
Absolutely.
How do those types of products look in today's environment? And are those areas that might have opportunities for someone like yourself who's looking for potential arbitrage?
Yeah, I think there's two things to consider about that, and one ties into your comment on the consumer. So if you go back 20 years, there was something called subprime for mortgages that were issued, and I'm sure everybody knows about what happened with that. Now they're called non-agency or non-QM. And it's a much smaller part of the market, but growing very rapidly. They're reviewing the delinquency data for non-agency mortgages. that were issued between 2022, 2023, and then the early part of 2024 are showing delinquency rates in the double digits, meaning more than 10 or 20% of the loan holders that made those, that took on those mortgages are defaulting on them or are more than 60 days delinquent. And that highlights the stress for the non-prime part of the consumer. The top 10% of consumers own a house, own a lot of stocks, or have a lot of their net worth in the financial markets. They've benefited greatly from the past 5 years. Stock prices are 2 times what they were. Their house is up 40 or 50%. Everything's great for that. The bottom 90% is faced with higher inflation, higher debt servicing costs, and they are defaulting on their debt very rapidly. So that really highlights the stress of the consumer that probably isn't seen. Thankfully, that market, I want to say, is 1/10 or 1/5 of the size of what it was 20 years ago. So the collateral impact on the overall financial system will be much more muted than what it was. But it really highlights the stress of what higher interest rates are having on people who don't qualify for an agency loan, meaning a Fannie Mae or Freddie Mac loan. They have to pay 8, 9% over the past couple of years. They can't afford it, especially because, so I'm sure everybody knows with the house, it's not just a mortgage payment. It's, you have the extra 1% of the value of the house that you have to budget in every year. Something breaks, you have to upgrade something, all that stuff. Secondarily, I mentioned earlier on that same space on the commercial side, because of the depressed expected value of the commercial real estate market and offices particularly, you're being paid an outrageous amount of yield or spread for an expected outcome of all the office buildings in the United States going to zero, like all the way to zero. And thinking about the highest tier tranches of those securities, that they're rated AAA, meaning you're getting paid back first, or of everybody. So you have to kind of have everything. Offices are like 25% of the overall commercial real estate market. If they go to zero and then 80% of stuff goes to zero, your principal is still intact, which to me is great. I'm getting paid 8 or 9%, and versus if I go buy bonds of Apple, I'm getting paid 4.5%. Why would I ever do that? It's a bit different liquidity, but yeah, I mean that's a way to be active. And you mentioned before about the aggregate bond index. When it was, created by Bill Gross 30 years ago, he created it to be beaten. That's the idea.
I honestly did not know Bill Gross is responsible for the ag.
That's his claim at PIMCO with Barclays. That's his claim 30 years ago. I'm not saying it's wrong or right. That's his claim was 30 plus years ago. I created the aggregate bond index when I was at PIMCO, and I created it so that it could be beaten because it's mostly treasuries. And if you buy agency mortgage-backed securities, you're getting paid 50 to 150 basis points more of spread. You could just sit there and own agency mortgages all day and kind of outperform on a pre-fees basis. So yeah, I mean that's how you can outperform the ag. But yeah, that's just one fun fact.
So let's talk a little bit about one of the products in your lineup that we at Bondran use in our model, which is RDFI. And a little bit about the use of closed-end funds in that product, because I think that's really unique. For our audience that doesn't understand closed-end funds, they are registered under the 40 Act, like a mutual fund or an ETF or an interval fund, but they trade in the market. But unlike an ETF, there's a premium discount aspect of it. They don't always reflect the value of the underlying security, whereas an ETF is always being priced based on the underlying value of what it holds. Whereas a closed-end fund is based on, the spread of the bid-ask of the actual fund. So there's potential arbitrage opportunities in addition to getting exposure to the fixed income products. So can you talk a little bit about how you kind of look at that and use that as a way to add potential for alpha for investors?
Absolutely. Thank you. With the closed-end funds, as I mentioned before, capturing the transition from a hiking cycle by the Federal Reserve to an interest rate cutting cycle is the big part about using closed-end funds. So they use a moderate amount of leverage, about 0.25 times leverage for the fixed income closed-end funds. And that varies by asset class. The more risky ones use less. the more safe ones like municipals use on the higher side. They're limited to 1.5, or I think it's about 1.42 times leverage by 1940 Act regulations. So they can't go more than that amount of leverage. And then they trade at a discount to their net asset value. That discount changes over time. It might be 0, it might be 10 or 15 or even 20 if things get really out of control. And the biggest thing that drives that change in the discount is the federal funds rate. Because they're using leverage, they're borrowing short to buy long. So if you're borrowing at the Fed funds rate and the yield curve is inverted, you're not getting any pickup on your yield. So your distribution might be negatively impacted. So like using an example, a closed-end fund has a $10 stock price and a 10-cent per month distribution. So it's a 12% yield. If the Fed raises interest rates, the amount of yield that they can pick up from their leverage goes down. So they might have to cut their distribution from 10 cents a month to 8.5 cents a month, which is pretty normal over a Fed hiking cycle. So now they've become less valuable. Their yield has gone down. So if their discount was at 5% going into that, it's probably going to widen to 10 or 15 or maybe 20% on the wide part. And you're also losing more money because you're long a fixed income asset, whatever that asset might be, on leverage. So you're losing more because of the leverage, and you're losing more because the discount to net asset value is widening. So your stock price is going down even faster. So you don't want to be involved, or you want to be using hedging techniques to try to mitigate that leverage risk, that duration risk, and that just overall risk of the discount widening. Now, fast forward, Fed's done raising interest rates. They're about to cut interest rates, and you can identify that. Well, likely that they've cut interest, that closed-end fund has cut their distribution rate per month from 10 cents to 8.5 cents. As the Fed cuts interest rates and their leverage costs come down, and the income they can generate in general goes up from 8.5 cents back to 10 cents, that discount, which is probably at 15% or in that ballpark, is going to tighten back to 5%, or maybe to 0 at that stage. I'm sure we'd be out when it got to 0, but it might get back to 0 or a premium at that stage, because that ETF that you might be able to buy is in the process of cutting their distribution because the yield has declined on what they're owning. So number 3 on top of all of that is you're now long fixed income again with 1.25 times leverage. So as your bond's going up, you're making 1.25 times everybody else. And maybe with a discount, you're picking up 1.5 of beta to everything else on the way up. And it's a bit uncorrelated because that discount might operate in an uncorrelated manner. So what we're trying to do with RDFI is to mitigate in a hiking cycle the pain that we know that's going to come. The discount's going to widen. We're going to have loss in the principal. So if we can mitigate that from having a higher cash balance or owning something that's beyond a closed-end fund, then we will do that. In an easing cycle like we're in now, we want to be as invested as we can be in closed-end funds to try to maximize that return, which is, that's been what we've gone through over the past decade with that strategy and using closed-end funds.
Interesting. Well, we're coming up on time, and I have one last question that I want to get in. And I know we talked about this before we pressed record, but I want to give you an opportunity to just touch upon one of the things I'm most excited about that your team's working on. As I mentioned, we use RDFI and our alternative income model that advisors have access to on our platform, and we're working towards some additional distribution with some partners. And when I can officially announce that, I will. But that said, you guys have a product that just came out onto the market that I'm particularly excited about. And I think, given that our audience is mostly folks that like to invest in alternative product, is worth noting, which is you guys just launched a Bitcoin gold fund, correct? Can you just give us a brief overview of that product so people know to go take a look at it?
Sure. So I'm sure individuals or advisors have used precious metals in their portfolios, and those vary based on the individual. It could be 0, it could be 25% of their portfolio, depending upon what they've used in the past. And Bitcoin and Ethereum as well have become the digital gold and digital silver of the crypto asset space. So what we've done is created a one-stop shop for your precious metals and crypto use in your portfolio. So, and because of the high volatility nature of that and the trajectory of those assets, we're using return stacking. So to have 75% gold, 25% silver, 75% Bitcoin, and 25% Ethereum to create 200% of exposure to get you, meaning you can have a 2% exposure if you wanted to have 2% to each in your portfolio. You can have a 2% weighting in your portfolio, and you can achieve all those things. The one thing it's doing differently from a return stacking perspective is to only rebalance when those assets have deviated away from their allocation bands. So funds that use leverage will rebalance typically every single day to keep that leverage. And as I'm sure everybody knows, when things go up, that works out great. And then when things go down, you're selling more to keep that target leverage, which means you're selling on the way down, and it makes it hard to get back to break even. So by having that rebalance trigger in bands, it's not going to rebalance it's not, but it would have it would be odd if it rebalanced every single day. So you have to wait over a period of time.
Well, that's really interesting. And for those in the audience who are not familiar with the whole concept of return stacking, I encourage you to go look for Brit. Brit's podcast, The Alternative Mason. She had Corey Hofstein on last spring, and the entire episode is about this concept of return stacking. So if you need a refresher, I encourage you to go check out that episode. But I'm really excited about that product that's coming out. I think it's interesting. I know it's not the first one on the market that's kind of doing the crypto precious metal thing, but I think it's doing it in the most unique way. So anybody who is interested, feel free to reach out to me, and I'll put you in touch with the folks at Rareview if you're interested in that product as well. Well, Michael, I am so thankful for your time. I really appreciate it. I'm really excited about our partnership with Rareview. I think you guys have some really unique products, and I don't think most advisors are as familiar with you as they might be with some of our other liquid alt products that are attached to companies that have a much more institutional kind of backing per se. What I mean by that is that the folks that started those firms came from, large institutions, and so they brought a little bit of that institution money with them. Rareview is a little bit different. Rareview has traditionally and at its core started out as an advisor for advisors. So that is everything we stand for at Bonrian, is about helping advisors pair with partners that understand their business and understand what it's like to be a financial advisor. And Rareview really stands out to me in that respect. So thank you for joining us. Thank you everyone for tuning in. Again, I am Shana Orzik-Sissel. I'm the founder and CEO of Rareview Capital Management. If you like this episode, make sure you like and subscribe. If you have an idea for a topic that we haven't covered, please put it in the comments. We'd love to hear from you. And with that, until next time. The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Rareview Capital Management's platform. As such, Rareview may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Rareview Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Rareview Capital trademarks mentioned are owned by Rareview Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.